Hello, how are you? I'm glad that you joined me for this class. I'm sure that these lessons are going to add value to you. They're going to make you more skillful. They're going to make you better in understanding forex trading. We said in earlier course, in earlier parts of this course, that if you can understand how to do something, if you can understand what goes on in forex trading platforms, in forex trading charts, then you are better placed to make a decision that is informed, a decision that will bear results even in this trade that you're getting into. So today basically we're going to be dealing with pips. You've heard of pips probably, or it's the first time you're hearing about it. You've heard of pairs. We mentioned that pairs are the couples that are put together in terms of currencies. And when you look at how they're dealt with, we say that when one gets stronger, the other gets weaker. So you need to understand, and we're gonna go into it, and you're going to understand why there's a difference in the pairs, or rather why there's that why there's a profit made when the pair changes. It changes in forms of pips. So that's what we're going to deal with today. So without taking any more time, I'm going to jump into it. I want you to just go ahead and grab your pen, grab your paper, your notebook, so that you're able to capture this particular thing. So we're dealing with currency, pairs, and pips. So the first thing that I should say concerning pairs is this: that a currency pair, it has movements. That movement is what we need to understand and capture. That movement is what is making wealth for you, either when it's selling or when it's buying. So in our presentation there, currency pair movements are traded in currencies are traded in pairs, since in their movements they are opposing each other like on a weighing scale. Okay, when one is getting stronger, the pair partner is getting weaker. There are many pairs, but we will mainly mention two. We're going to deal with the major pairs, and then we're also going to deal with the minor pairs. They are also known as crosses. They're known as crosses. So in forex trading, the pairs involved in heavy forex trading are listed here. We've put up a graph for you, and you're able to have a look at this pair. This particular, on one side of your screen is just the currency. You have the USD on the top, you have the euro, you have the Japanese yen, and then you have EME. EME refers to some of the emerging stocks. We're talking about Dubai and others, with an exclusion of Russia and the Chinese currency. But these are some of the major currencies, and then this is how they are traded. If you look at the pairs on the other side, you have the USD euro. You can see there USD / EUR. That's the USD euro pair. We call it a USD euro pair because it's a pair of two currencies. You have the USD Japanese yen. That's another pair right there. Then you have the USD and the British pound, the sterling pound, the British sterling pound. There it is. Then you have the USD with emerging, like I had said. So these are the pairs that are involved in heavy forex trading. These are some of the pairs. But let's go on looking at pairs. Before we go on, there's some information here from Triennial Central Bank Survey, a survey that was done. It shows how, it shows the strength of these particular pairs. So these are pairs to look out for. When you're determining what you're going to trade, these are good pairs to be able to look at in times to come. So you're able to choose a particular, because it's your choice. When you go to the platform, you will be able to identify which particular pair you want to trade. In fact, what I should do right away is I should probably go to my platform. I should go to my platform here, and then from my platform I go ahead and show you where we choose the pairs from. We said we're going to understand this whole platform. We're going to understand these tables. They're not going to be confusing us in the future. We will know what are all this going on. So we're starting up here on the left top corner. It's written, there's a symbol there. But this is where we search for the different symbols. When you come here and click on Forex, let's start with the first one. You have all the different pairs that are possible for you to trade, depending on your platform. So this is where you come and choose. You said you come here, you choose a symbol that you want. All this on this first column here is where you have, in fact, TradingView has the flag, then the flags of the pairs, then it has the particular symbol. Here we have the EUR USD. That's the euro versus the dollar. Euro versus dollar. Okay, this is just the name of your broker. I'm dealing with Pepperstone for this particular sessions, and I want you to just note that this is TradingView, but when you move to another platform, the other platform may display this differently, but the symbols are the same. You have the Euro USD, GBP USD, the Aussie. This is the Australian dollar versus the US dollar. Then you have this symbol is for US dollar versus the Japanese yen. It goes on and on and on and on. So you choose the one you want based on the information that you have gotten about it, based on your strategy. What have you chosen to be dealing with? What have you chosen to deal with? There are different symbols, and we will talk about other things. You can also choose different futures. Here you see we have different futures. There are so many futures. We'll talk about futures later. For those of you who are crypto lovers, we also have cryptos here, So this is where you choose your symbols. But in Forex, we deal with the pairs. But now what we're saying here is in the platform, it gives you the opportunity to now choose not just the pairs, but even other assets. Anyway, let's stick with the Forex because that's what this basis of our study is. And then we will move on. So this is where you choose the pairs. That's where you choose the pairs. I think it is important for me to point out at this juncture that when you choose a particular pair, what we're learning in Forex trading, what usually happens with pairs, there are very many similarities with what happens with other assets. So when you know how to choose an asset and then how to check its indications, how to check its movement, its trend, that's the same knowledge that you will use from this course and this training to be able to decide to make a decision where crypto is concerned, to make a decision where futures are concerned, to make a decision where even stock market assets are concerned. So what you're learning here is amazing. It will just go ahead and help you be able to do what you're doing, or rather what you're learning here will help you be able to determine what you should do and how you should make your decisions. Now, we are saying that the pairs, you choose a pair. The pair, when one is getting stronger, one is getting weaker. The pair that you choose, we have seen that there are many pairs. There are stronger pairs. There are more fluid pairs. You've seen the charts. There are pairs that are very, very, very heavily traded. So you need to look out for those pairs. And going forward, you'll be able to understand the different pairs that there are, because there are very many different pairs available in the market, in the stock market. If we can just carry on here and have a look at our presentation, we find that the major currency pairs that trade the most volume against the US, the currencies that trade the most volume against the US dollar are referred to as the major currency pairs. So here they are listed for you, like I showed you in the platform. The Euro USD, the Euro versus the USD versus the Japanese yen. Those are the main ones. GBP USD. Those are the main currency pairs. Now we said there are major currency pairs, and then there are also minor or exotic currency pairs. Those are pairs that are not as volatile, or rather they're not heavily used. Currency pairs that are not associated with the US dollar are referred to as minor currencies or crosses. These pairs have slightly wider spreads and are not as liquid as the majors, but they are traded nonetheless. The idea is to choose an active cross if not trading the majors. So what we're saying is that if you're not trading the majors, you're not stuck to trading the US dollar you don't have to be stuck to trading pairs that have the US dollar. You can trade another different pair, like I showed you the minor pairs, but you need to choose a pair that is active. It's being traded. It's busy. It's a busy pair. And the ones that now we have showed you there are like the GBP versus the GPY. This is the sterling pound versus the Japanese yen. There's no US dollar there in that pair, but it's a heavily traded pair. There's the euro versus the sterling pound. You remember that when Britain, when Britain, when Brexit happened, Britain did no longer depend on the euro currency. So that is a trading that happens. There's a good market there where we trade the euro versus the sterling pound. Then you have the AUD CAD. That's the Aussie Australian dollar versus the Canadian dollar. That's also a pair that doesn't have the USD there, but it's an active and it's a good cross. We call it a cross. So moving on, I think we can we've dealt with the minor and exotic currencies. We can go on to mention, or rather give you an explanation about the base currency. What do we call the base currency, and what do we call let me show you right here. When dealing with currency, the currency pair, when dealing with currency pair names, it is important to be aware which currency is gaining or losing. Yes, you need to note which one is gaining versus which one is losing. This only can happen if you foundationally know that in a pair there is a base currency, that's the first in the pair, and then there is a quote currency, the one paired with it. So like when you're looking at now the GBP JPY, I've explained here that the GBP is the base currency, and then the GPY is the quote currency. Okay, so the first one on your left is the base currency, and the one on the right is called the quote currency. So when we have an example of Euro GBP, then it follows Euro is the base currency and GBP is the quote currency. So here is now the example that we're giving. When you read GBP JPY is at 185.11, that's just a random number I've picked. That means that one British pound, one sterling pound is the base and is equals to 185.11 of the Japanese yen. So it's the base. The one on the left is always 1. Okay, so 1 of the GBP is equals to 185 of the yen. So that's the exchange currency. So these are fundamental things that you need to understand right from the word go when you're starting to learn Forex. And once you have known some of these fundamental things, from there on you will just be able to sail, because when you look at a price quoted, you know which is the base, which is the quote price. When you look at any pair, so we've looked at what pairs are, but we've gone on to also check that when a pair is, when you're given the costing of a particular pair, you're able to tell by just looking at it what is the quote, what is the base currency. So moving on, I can just go ahead and talk about pips. Now, just before I talk about the pips, I need you to first of all get get confident that you've understood what pairs are. When you understand what pairs are, you now move on to that strength difference. We talked about the strength difference. When one in the pair is going up, the other in the pair is going down. So there's that fluctuation, there's that change. How do we calculate that change? That fluctuation is calculated using a certain measurement called a pip. So that introduces us now to the next thing in our lesson here. And I know that you're going to understand this. And when you understand this, you will have now understood the pairs, and you will have understood the the measurements. So a pip, PIP, pips, a pip is an acronym for percentage in point or price interest in point. Now, a pip, it is the smallest whole unit price move. That movement of price we're talking about between the stronger one and the weaker one, that change, okay, is what we're saying is measured. That small whole unit in the rate, okay, is what is called a pip according to the forex market convention. So the forex market as a whole understands what a pip is, so that a pip is not $1 or 1 yen or you will understand it's a certain value that is understood by the forex market, and you will understand it too. So most currency pairs are priced out to 4 decimal places, and a single pip is in the 4th decimal place. That is 1/1000. Okay, for example, the smallest whole unit move of the USD with the Canadian dollar can make, or rather that the smallest move that it can make is 0.0001 or 1 pip. Don't worry, you will understand this in a very short while. But this is what we're saying, that we're saying that the movement of currency is usually in a very minute, there's very minute fluctuation. But that minute fluctuation is what makes money or loses money in forex industry. So you need to understand the value. What do we call a pip? What we call a pip is 0.0000, the 4th decimal. That's it's a very small fraction of movement that makes money.